a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about oil ETFs. And oil prices have surged to their highest levels in about 7 years. They are currently trading around $87, $88 a barrel. And that is mainly because of these recent geopolitical tensions. There has been assembly of Russian troops on the Ukrainian border, and in the Middle East, there have been attacks, some missile attacks by Houthi rebels on UAE's oil facilities. So in the near term, there is risk of supply disruptions that has caused the spike in oil prices. And looking at slightly longer term over the coming months, the demand for oil is likely to return to pre-pandemic levels, because we have seen that the impact of Omicron variant of the coronavirus is not as bad as that of some of the other earlier variants. And while the demand returns to its pre-pandemic levels, we have seen that inventories are quite low, and there is very little spare capacity to raise inventories and supply in the near term. So there are some analysts on Wall Street who are calling for $100 a barrel oil by this summer, and that level has not been seen since 2014. Now the OPEC plus the OPEC cartel and its allies, they are meeting this Wednesday to decide about oil supply, and they control the oil output. Now, we also know that in the US in particular, and Europe as well, investments into fossil fuels has gone down a lot, whereas the transition to renewable energy is still a few years away. So that is also causing this volatility in oil prices, and that is one of the reasons why oil prices have gone up a lot. Now, looking at the ETFs, there are energy equity ETFs which invest in stocks of oil companies, energy companies, exploration and production companies, and other energy companies. So ETFs like XLE and VDE. Now, I talked about energy equity ETFs in October last year, so please watch that video if you want to learn more about those ETFs. Those are suited more for longer term investors because these hold stocks. Then there are leverage ETFs like GUSH and NRGU, which provide twice and thrice leverage exposure to energy equities. These are meant for very short-term trading only because of their leverage. Please use caution. And if you decide to invest in those ETFs, they have become very popular with retail investors lately. Today, I'm focusing on energy commodity ETFs. These ETFs try to track the prices of crude, either the WTI, which is West Texas Intermediary, or the Brent, which is the more global oil. These invest in futures of WTI or Brent. Now, as I have mentioned many times, ETFs that hold futures, they have to roll futures, so they can have the impact of either contango or backwardation. Now, contango means contracts that are expiring in later months. They are more expensive than month futures. So whenever the ETF manager rolls over those contracts, they incur roll costs, and that is why the impact of contango is negative. Backwardation is the reverse of contango, and in fact, currently the global oil markets are in backwardation, which is rather rare. Usually, markets are in contango. So that means currently spot and near-term future contracts are more expensive than crude futures contracts, which expire in the future. And so there is that is why there is, instead of roll cost, there is roll yield. So that means the manager gains something when they roll over into futures contracts that are expiring later. Now let's take a look at three popular ETFs that invest in these futures contracts. Let's go to the quote page on Zacks.com. So the first one I'm talking about is the most popular oil ETF. The ticker symbol is USO. This ETF was in news in April of 2020 because of the havoc in oil markets when futures had gone negative. So this ETF was it used to earlier hold the front month futures contracts, but because of that turmoil in oil futures market, it had to change its strategy, and now it holds near-term futures, not only front month futures, but near-term futures on WTI. The expense ratio is 79 basis points and very, very popular with over 2.5 billion in assets. To learn more, you can read our research report articles. You can go to the external homepage using the link on Zacks.com. And I highly recommend that you read. It also talks about the events that occurred during the spring of 2020. As I mentioned, oil futures prices had gone negative then. So what it holds currently is contracts which are expiring in March, April, May, June, July, August, and December. So not only front month, but several months in the future as well. The second one I'll mention is the ticker symbol is BNO. Unlike WTI, this holds futures contracts on Brent, and this tries to hold near-term futures contracts. So this would be very sensitive to spot prices of oil. So front month and very near-term futures contracts are closely related with spot prices, whereas the contracts which are expiring later, they are not as closely correlated with spot prices. Slightly pricier and smaller to 243 million in assets and 90 basis point expense ratio. Again, to learn more, you can use the link on Zacks.com and go to the web page for the CTF, and you will see that it holds Brent futures contracts which are expiring in April. Now, the third one, which I am highlighting, is slightly different. The ticker symbol is USO. So this tries to avoid or beat the impact of contango, minimize the impact of contango. So this not only holds near-term futures, it holds 12 nearest months futures contracts. So the impact of rolling over would be low. The expense ratio is 88 basis points, and this is smaller, 149 million in assets. And you can use the link on Zacks.com to go to the quote page, and you will see that it holds futures contracts expiring in March through February 2023. Now, all these three ETFs, they are structured as commodity pools, so they will issue the K1 form. That is one tax headache which you should be prepared for. And these are also should be held for shorter term. These are not long-term investments because of investing in futures. On the last slide, I have the comparative performance of these three ETFs versus the S&P 500 index. And you will see that all these have been pretty volatile, but on the uptrend over the past year, and particularly this year, they have surged. And now the one-year return for all three is pretty close, about 68 to 70%, whereas the S&P 500 index is now up about 19% over the past year, which is thanks mainly to all the turmoil, volatility that we have seen this year. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and I will see you next week.